Hi there, everyone. It's Peter Hunt here from Moneywatch Finance. Just going to give you an update on mortgage affordability. I did sort of a number of weeks ago present a very quick look at how we can calculate and how we work out people's affordability. I've had a number of requests and a bit of feedback asking if I can elaborate on that a little bit more, so I'm quite gladly going to do that for you today. I still get quite a lot of people come forward and say, hi there, I'm looking to get a mortgage, I'm a first time buyer, I earn 25,000 a year, my partner earns 15,000 a year, what can I borrow? And my answer to that is, I don't know. Because from that information it's impossible to calculate what your eligibility is. And get my words out here. Deposits obviously going to play a major part in it. Your credit history is also going to make a major impact on it. But also, I don't at this point understand and have the knowledge of the full picture of your situation. What credit commitments have you got in place? So there's a lot of things that will influence it. So I'm going to share this bit of software that we've got here. So hopefully in a short period of time, you will see this come up on your screen. I'm going to briefly explain what we've got here. It is really important. What we've got is somebody known as Mr. Want to Buy a Home. I think you'll find his partner is Miss I Also Want to Buy a Home. And they're looking to buy ideally a semi-detached house for £250,000. They've worked really hard. They've got themselves a 10% deposit, 25,000. So they've done really well. Obviously, the more deposit that somebody can get, the better interest rates you're going to obtain from lenders. But for this exercise, we're going to look at somebody that's worked extremely hard and has managed to get themselves that 10% deposit. We're looking to do the mortgage over a 35-year term because that will keep their monthly mortgage payments affordable and lower in those early years. So it will hopefully enable them to borrow that little bit more. And we've got their details in, so some dates of birth. Both applicants are going to be living at home with parents. So there's two applicants going to be part of this mortgage. So first applicant, I'm going to keep them both the same for the purpose of this exercise. But the one person's earning 25,000 a year. So once they've paid tax and national insurance, there's the net take-home pay. Okay. Keeping things simple, we're not going to build any bonus into the equation. We're not going to build any overtime into the equation because, again, those are additional things that lenders will take into consideration, but they won't always take all of the income. So we're just going to keep it simplified today, to be honest. Okay. The gentleman's got a student loan, okay, which is not unusual. Okay, and there's no other outstanding credit commitments. Got no loans, no credit cards, no personal loans, nothing like that. The property that they're going to be buying, obviously there are certain expenditures that are going to incur. So we've put down that quite conservatively £90 for the council tax, buildings insurance £25, and £480, as you'll see here, is to cover any other household expenditure. So utilities, gas, electric, water, mobile phones, telephone, internet, food and groceries, clothes, and if they've got pets and medical. So we've worked on a basis of £480 there. Petrol consumption, we've worked on £75, and pension contributions also the same. So here's the partner, and again, as I say, to keep it all universal, we've worked on the same information: 25,000 salary, 1,680 net income, no outstanding loans or credit commitments. The household expenditure has already been put into applicant one's details, so we don't need to replicate that again. And again, pension contributions, this person's travel expenses a little bit less at £50. So what we're now going to do is run an affordability calculator. This system, this piece of software, is now going to access all the various different lenders' affordability calculators, and it will produce us a report to tell us, can they borrow the 225,000 they need to buy that dream home that they want? Okay, so it's contacting all of the different lenders, and while it's doing this, this also comes back to the fact of another question I get asked is, what's the best interest rate you can get? And again, the answer to that question will always be, I don't know. And the reason for that is because I don't know which lender, which product, what interest rate you're going to qualify for based on your own personal financial circumstances. So although there's, I don't know, 70, 80 different lenders out there, probably more, not all of those may lend, as you'll probably see from this report. So this couple here are looking for a £225,000 mortgage to buy themselves a property of 250,000. I know some people may want to buy more, some may want to buy less, but this is a good sort of indication. So here we go. What this is evidencing is that we've got 9 lenders that would be prepared to lend them 225,000 to buy that home. So the clients have been in and they've said to me, we've seen a really good mortgage with Halifax. We want to buy a property of 250,000. We need to borrow 225,000. Halifax have got the best market leading rate. We want that mortgage. Unfortunately, Halifax are falling short. So if you want that dream home, you either need to get some more deposit, or you need to reevaluate the value of the property that you want to go for if you're looking for that best rate. As you can see here, it goes down. NatWest will only lend 212,500. Kent Reliance, West Bromwich Building, same, much lower. So what we're looking at now is, if you're determined that you want that £250,000 property, we're looking for the most appropriate mortgage from this group of lenders. Okay, so highest is coming in with Aldermore at 274,999. We've got Coventry at 225,000. Now that's fairly simple. It's nothing untoward about that. But what we're going to do, we're going to slightly complicate the matter now. I bet you didn't know I was going to do this. But what we're going to do now is put this couple now have got a child. Children, as you probably know, anybody out there that's got children, are expensive. Okay, so we've got one child. Okay, we're now going to come down and we're now going to give this person, which is not unrealistic, a £2,000 credit card balance, which is not going to be paid off. Hasn't got the funds, he's saved up, or they've both saved up really hard to get a deposit, and they can't afford to save that deposit and pay that credit card balance off. But he's also got a car loan, which pays £250 a month on, and that's still going to remain after the new mortgage. And there's 3 years left on this car loan, so there's roughly about £9,000 outstanding on the card, on the loan. Okay. The other thing is, because they've got a child and both parents need to go back to work, they're going to incur childminding fees. They're not fortunate where they've got brothers or sisters or parents that are there to help. They've got childminding fees or nursery fees, and those equate to £300 a month. Okay, I've put all those expenditures in the first applicant's situation, because it doesn't matter whether we put it into one or two, or whether we split it between the two. So what we're going to do now that we've put that information in, we're now going to reevaluate, and we're going to have a look and see, is it still possible for this couple to buy that £250,000 property with those expenditures? If they can, excellent, it's good news. If they can't, then it may well be that they need to reevaluate the level of property that they look to buy. So as you can see now, this is contacting all the various different lenders' affordability calculators. It's now going to produce us an updated report. And soon we'll be able to either give them the good news or the bad news. But the benefit of doing this is that it targets, if you do this early in the process before you start looking at properties, this will focus your attentions in the correct price range of property that you need to be considering. And there we go. So now, when we didn't have all that expenditure and we didn't have that young child, we had a choice of 9 mortgages potentially available. That's now reduced to just 4. So we can see Precise is now the one that would be prepared to lend the most. Quite interestingly, with all that expenditure, they're lending 237,500. The first calculation we did, Precise would also lend 237,500. So they've not reduced what they're prepared to consider lending, even with all that extra expenditure. However, Aldermore, they've completely reevaluated. Previously, they would have considered lending up to £274,999. That's now reduced down to £229,436. That's a huge difference of £45,563 reduction. Digital, well, theirs hasn't changed either, quite interestingly. They would lend 225,000 before, and they'll still look at lending 225,000, as will Ipswich Building Society. So we can still buy that property if we want, okay, but we're now reducing the choice of mortgage products that we've got from 9 down to 4. So it's irrelevant if we wanted that mortgage product with Halifax. Halifax have got the market leading rate, or Barclays have got the market leading rate. It doesn't matter. One of these lenders could have the market leading rate. If you want that property of 250,000 with your 10% deposit, you're not getting that product. And this is why it's so important, so important to get that affordability calculation done early before you start looking at properties, because the worst thing you do is you find the property you want and then find that it's not feasible to buy, and it's the disappointment that kicks in. So you've got a good indication there. There's some very big lenders on there, some well-known lenders. There's also quite a few unknown lenders that you may not have heard of. But the emphasis is on affordability. Now, I hope that's been beneficial. I'm going to come back to you. I hope that's been beneficial. It emphasises, and please do take it seriously. It's so important to get that affordability calculation done early in the process. It's a lovely piece of software that we have access to. Do you have access to it as a member of the public? Unfortunately, no. Is it free? No. We have to pay for this piece of software, but that's where our expertise comes in, and our knowledge of looking at lenders' affordabilities. The one thing that affordability piece of software doesn't do is take into consideration your credit history, as I mentioned earlier. So if you've had defaults, county court judgments, if you've had numerous late payments on loans, credit cards, any other things like that, that can impact on your credit score, and that is potentially going to impact on which lenders will or won't proceed. So again, I can't emphasize strongly enough, get advice early in the process, especially if you're a first-time buyer, or whether you're a first-time buyer or a home mover. You still need to know that whatever you're looking to do is affordable. So have a good weekend, everyone. Hope everybody's well. There's a light at the end of the tunnel with the vaccine. I've had mine, and I've got my second one in May. So keep well, keep safe, and see you again soon.